Harry Gold here. Today we're talking about covered calls versus buy and hold. And we're specifically going to look into Apple. Now, long-term buy and hold has its merits, but so does selling monthly covered calls. And we're going to take a look into both. Let's take a look at the agenda for today. The dilemma, HODL or covered calls. Obviously, if you're familiar with crypto, HODL stands for hold on for dear life. Same concept applies to stocks. Covered calls, we're talking about selling options. I'm gonna stick with every 30 days. How full-time trading became possible. I'm gonna talk about how I was able to make the leap to become a full-time trader because I relied on selling options. Reviewing the first backtest, we're gonna look at this Apple backtest and see what happened when we sold these covered calls monthly. Then we're going to look at some backtest adjustments, maybe some ways that we can perform better. And then we're going to discuss key takeaways. So let's discuss the dilemma. First, I want to revisit this idea that it's a story, it's a myth that's told over and over about how some of the best performing portfolios belonged to people that were deceased. So the idea is that people make bad decisions in the short term. And the best performing portfolios, the reason why they belong to dead people was because they weren't alive to make any decisions to screw up their investments. They couldn't sell Tesla too early, for example. They couldn't sell Apple. They couldn't sell any of these amazing investments too early because they died, right? So the idea is that the best performing portfolios belong to people that have died. Simply because the longest hold period is forever and they weren't around to screw things up. But the truth is, that's a myth. That study does not actually exist. It was allegedly a fidelity study, but there's no evidence that that was ever proven, and I personally don't believe it's true. I believe active management of your portfolio, even if it's revisiting once every few years, once every year. I mean, obviously I'm an active trader. I believe it's possible to make good short-term decisions that outperform passive investing. Obviously, you could be anywhere from just invest in an index or invest in the S&P all the way to active day trading or scalping, right? And then, of course, there's everything in the middle. So selling monthly covered calls is obviously somewhere in the middle. It takes some sort of activity and some sort of knowledge, but you don't have to spend 8 hours a day sitting at a screen in order to do it. There's merits to both, there's pros and cons to both. So that's what we're going to look at today. I want to talk about how full-time trading became possible for myself, and this might apply to you as well. Even if you don't want to be a full-time trader, it just might provide some insight into the power of selling options, and of course backtesting. Now, I dedicated myself to full-time trading in July of last year, so this is actually my 1-year anniversary. And there were plenty of investments that I saw that I thought were amazing. Obviously, airlines crashed, cruise lines crashed, Bitcoin was between 5 to 10,000, and they were good ideas. If you bought at the bottom of the market crash and held until now, you would have made a ton of money. But the problem is, hindsight is 20/20, and we can't predict the future. For all I knew, the market was going to stay depressed for months and months, maybe years. I don't know. How does anyone know? But what I did know was that I could find stocks that I felt were good investments, and I could sell options on them. I could sell covered calls, I could sell puts. So specifically, I was fortunate enough to get into Bitcoin at 5,000 about just over a year ago, and I sold it at 10,000, and I was thrilled. Obviously, I doubled my money in a couple months. I felt that Bitcoin had a lot of potential, but I didn't know how much it was going to go up, and I didn't know when it was going to go up. So as someone that wanted to pursue full-time options trading, I felt I had no choice but to sell my Bitcoin, because when you sell options, you're providing that predictable income. Now, it's not a guarantee, but making a few percentage points every month on stocks felt much more stable and predictable than just sitting on Bitcoin. Now, at the time, I was right all the way up until October. So from like maybe May or June until October, Bitcoin, I want to say, stayed around 10,000. And then it took off to the mid 60,000s over the next few months. But from that period of June until October, I was collecting a consistent income selling options. So I was able to sleep at night, I was able to feed myself, I was able to go about my day without stressing, because I was producing that predictable income by selling cash secured puts and covered calls. If you do find a good investment, how much more stable would you feel if you can rely on that as an investment in general, but then you're collecting those upfront premiums? We're going to look at Edelta Pro. Just going to log in here. Backtest. Start a new backtest. And I'm going to check out selling covered calls on Apple 30 days out. Apple. We want to do covered call. So we're buying 100 shares of the stock, and we're selling a covered call right at 50. So this means we're not looking for any capital appreciation in Apple. We're just trying to benefit from the premium that we're going to get from selling the call, and it's going to be backed by these 100 shares of Apple. Now, we want to look at 30 days until expiration, and we're going to do daily. This way we get more data. So every single day a trade is going to be opened that expires in 30 days. Also, let's check out the dates. I want to look at the past 5 years. Okay, perfect. So from December 31st, so the very end of 2015 to the very end of 2020, which is going to be 5 years. All right, let's run. Okay, so here's what we got. Over the past 5 years, we have an 89% return on capital. So just real quick, if you take 89% and say 89% divided by 5, that gives us 17.8% annually. So if you knew that you can make 17.8% annually, regardless of how fast or how slow Apple went up in value, that would be incredible. So if you're part of the FIRE movement, or you've heard of the FIRE movement, FIRE stands for Financial Independence, Retire Early. People always talk about getting to your number and knowing what percent return you can rely on in your portfolio. And basically, the most conservative people that are part of this movement will look at something like 5% annual returns on their portfolio, or 4% or 6% or something like that. But if you are only planning on living off of 5% of your portfolio, I mean, if you have $1 million, then 5% is $50. If you have $1 million and 5% a year is $50,000. So imagine how much less money you would need for financial independence, retiring early, if your number is actually 17.8%. You no longer need that million to make that 50,000 a year. Maybe you need 200,000 or 250,000. Now, obviously, I'm not a financial advisor. I can't guarantee these numbers, but if you're selling options on something as stable and reliable as Apple, and you can come up with a consistent 17.8% annual return, that's pretty significant, and that's obviously something that you might want to investigate if you're part of the FIRE movement. We see the max drawdown was pretty significant. I imagine it's referring to when the market fell during COVID recently. By the way, I also want to point out we're looking at 1,242 occurrences. This is because we opened a trade every single day over the past 5 years. So this button here, this button tracks how the stock performed versus the strategy. So the gray line is actually Apple, and the blue line is how selling the covered call performed. I'm pretty sure this big drop here is actually the stock split about a year ago. But you can see how selling the option roughly mirrors the performance of the stock itself. Now, looking at this, it's very clear that holding the stock performed better. But remember the story that I told. So I think as humans, we all have a shortcoming where we can't predict the future. If everyone knew Apple was going to go way up, they would all buy immediately because the market's efficient, or so they say, and it would be up already, and you would miss out because, in theory, the market reacts to all available information. So I can't predict the future. I don't have a crystal ball. I'm not a fortune teller. I don't even know what I'm going to eat for dinner tonight. So how can I know if Apple or any stock is going to go up enough for me to live off of on a consistent basis? I don't. So that's why it's compelling to be able to sell the option on it. Because if I already think Apple is a stable investment, I can collect a consistent premium from selling the covered call. Now, let's say Apple drops. Well, I'm still in a stock that I think is a good investment, and at least I collected my premium on the way down. I also want to point out that this strategy has a 79% win rate. Now, how comfortable would you feel living off of call premiums if your strategy was going to have a 79% win rate? Let's check out stockcharts.com. Let's look at Apple, and I want to look at the time period that we're discussing. Apple, oh wow, we already had Apple up, amazing. So, predefined range, select start dates. We're looking at 2015, 12/31, done. And then we're looking at 2020, 12/31, okay, done. So, if you're checking this out, we can see that Apple went from 23.25 all the way up to 132.27. Here we go. So 132.27 minus wherever Apple was 5 years ago, 24.30 minus 24.30. So that's the amount that Apple went up, $108 approximately. So let's take that 107.97 divided by 24.30. So if we turn this into a percentage, basically you can see that Apple went up 444% over the past 5 years, from the end of 2015 to the end of 2020. And obviously 444% is way higher than 89%. Okay, now I want to talk about some backtest adjustments. My goal is to find a way to beat 89% live. I didn't plan these adjustments ahead of time. We're just going to see what we can find. So let's go back up here. Now, of course, we're going back in time and we're trying to mitigate some of the losses with information we already have. But it might be useful for planning, right? If there's tweaks we can make that help us have better returns over the past 5 years, that's a good suggestion that those tweaks would help us perform better over the next 5 years. Now, it's not a guarantee, but it's better than going in blind. So something that I might be thinking about doing is I'm gonna mess with the days until expiration. There's an idea that if you sell options further out, you're gonna collect more premium, and that premium might outperform how the stock does, so we're gonna see. We're gonna check it out. Well, as we can see, longer periods until expiration did not help us. But now we know. Over 1,234 occurrences, we know that going from 30 to 45 days did not help us. So let's go back to 30 days. Let's go back to 30 days, but instead, this time, we're going to have a stop loss. Somehow we went backwards. I guess cutting losses did not help us here. So, in hindsight, we know that Apple did go up. So let's consider the idea where we do want to benefit from the capital appreciation of the stock itself just a little bit. You know what? Let's do percentages so we know. So every month we're selling a covered call 3% above wherever Apple is trading. So we might want to find some sort of way to benefit from that movement, especially if we assume this pattern of just Apple going up over the long term continues. So maybe we want the benefit of selling option premium, but maybe we also want the benefit of Apple actually moving up as well. Okay, there you go. A simple adjustment gets us much closer. So 189%, we more than doubled our original attempt of just selling an at-the-money covered call by just taking a 3% move of Apple going up. There's absolutely ways to mess with this more. Remember, you're benefiting from selling this call, but you're also benefiting from Apple moving, your 100 shares of Apple moving up that 3% until the shares get called away. Now imagine if you're part of the FIRE movement and you have an 189% return on capital over 5 years. So let's take that 189 divided by 5. That's 37.8%. Now it's not a guarantee. It doesn't happen every year. I'm sure it didn't happen every year. In this case, that's just the average. But imagine how much less money you need for financial independence if you can make 38% per year. I mean, if you have $100,000, that's $38,000 a year in cash flow, basically. So I think that's significant, and I think it's something that you might want to think about if you're an investor. So let's talk about key takeaways. At the end of the day, selling options on your positions long term is just something to look deeper into. You might want to look at the stock that you are familiar with, that you want to invest in anyway, and just look at the pros and cons, maybe through a platform such as Edelta Pro, to figure out if selling options would be worthwhile. Now, over time, we saw that Apple did go up more than it would have if you sold the monthly option. However, I discussed previously how you just don't know how much something is going to move and how soon. So sometimes it's better to collect that recurring income, and you still fare pretty well when you do so. There are plenty of times where individuals have asked me how to invest, and my answer has been, well, if you can afford 200 shares of a good investment, take 100 of them to just benefit from the long-term capital appreciation, and then take another 100 of them and just sell calls and puts on them, sell cash secured puts until you get assigned the shares, and then sell covered calls until the shares get taken away, so that you can experience some of those benefits of consistent cash flow. I think both investment methods are valid. I think based on the implied volatility of the particular stock that you're looking at, one may end up being better in the long run, but it really all comes down to you. Now, as you can see, we made some adjustments in our backtest to find ways to increase the return on capital, how it would have performed over the past 5 years. What I personally like about trading options is you're sitting in the driver's seat. You can make those adjustments in your backtesting and see how and why it would have performed a certain way, and then you could trade that way. So if you have the desire to be active and you want to figure out a way that would beat the typical buy and hold, I'm absolutely sure that you can find a way, probably through Edelta Pro. So, for example, I beat the S&P all the time because I've found back-tested strategies through Edelta Pro that has allowed me to collect a consistent return on a weekly basis and on a monthly basis from the S&P. I wasn't able to do it here today with Apple, but it's very possible to do in general. All right, see you next time.